Well, we're very happy once again to talk with the highly esteemed CEO of the Mortgage Lab, Rupert Gough. It feels like I should say Rupert Gough Esquire, Rupert, because we love, we love like
Rupert Gough the third.
Yeah. We love seeing your columns on One Roof. You're on the TV. You're everywhere. I don't think you're overexposed, but you're everywhere. So it's a big honour for us to have you today.
Someone did describe me as oversaturated actually recently, but
fear not. You're only oversaturated in the shower. So the things we want to chat to you about today get the unique perspective because you and your team across the country are dealing with all the time to break or not to break, especially I guess in terms of what's going to happen with interest rates. That's point one. And the second is borrowing for other investments, so shares, crypto, NFTs. What's the bank's feel? What's, I guess, your view from what you're seeing on the coalface? So can you share some insights with those two things?
Yeah, well, let's talk about break-in first because I think that's really topical to right now. So in the past 6 months, we've seen interest rates go from 2.09 to 3.65. So I'm talking the 1 year fixed rate there. So big jump. And what people are thinking is, well, look, if I break now, then if it keeps going up, I'm going to lock in this albeit terrible rate compared to what it was, but is it going to be even worse in the future? Mm. So there are a couple of things that you have to think about, and it's a little tricky to do via video or podcast or however you listen to this. Mm. But essentially what you want to think about is how long until that refix occurs. So if you just left your account to sit there, your refix would be due in, say, 6 months' time. Okay, so that's 6 months. What premium am I going to be paying in the meantime? So you locked at 2.09 and you've got 6 more months left to go on that. If you break today, you would be paying 1.5% more. So that's your premium for 6 months. So 1.5% premium times half a year, you're basically paying 0.75% of your mortgage additional for the bet that today's interest rate is better than 6 months. So based on that, the amount of time left and the premium you're going to pay in the meantime, do you think the rates are going to move by 0.75%, because that's what we figured out the premium you're going to pay, in the next 6 months? And if you do, if your view is that in 6 months' time it's going to be another % higher, then you would break that. Speaking purely from a financial perspective.
Okay, so just because now my head's spinning.
That's right. Yeah,
I've only been talking for 3 minutes. All right. So just
everyone's gone.
yeah. It was nice having you all. Just to recap that. So, but actually, some of that did actually click. So, in other words, you're at a rate of 2-ish, and you're staring down the barrel of 3.5 plus, right? This is the movement, and so if you figure out, okay, just to recap, you break now, but you've still got 6 months to go on this wonderful low rate. Right, so you're kind of trying to figure out, okay, I'm going to have to pay that much more, but for now I'm being penalised effectively because for 6 months I'm on this higher rate. Is it worth it looking at maybe then that will end up being a lower rate in a couple of years to come? That's what you said, right?
Well, you can't really forecast beyond the next refix because, for starters, anyone that says they can is just outright lying because so many things are affecting the economy at the moment. It's really about, is the next refix that you've got due going to be, if you do it now, is it going to be cheaper than in the future? And are you willing to pay a premium in the meantime? Almost everyone who breaks a rate today will be paying more than they fixed it for last year because they were awesome last year. So are you willing to pay that extra amount and, in the meantime, just to lock in what could be a good rate in hindsight in 6 months? months' time. And look, and this is what's so frustrating is that people, they email us and message us and say, should we break now? There is so much in that formula. You have to have a pretty solid view of where the rates are going in the next however long until you refix. You have to understand the premium that you're paying in the meantime. So to go back to our example, the example I use, you were paying 0.75% premium, but you had the view that in 6 months' time the rate was going to be 1% higher. So you've saved 0.25% by breaking now. But to me, look, I mean, I don't want to sound privileged, but to me that risk of just 0.25 on a bet just doesn't seem worth it. You'd have to see a wild swing, in my opinion, because you don't want to just break even. You don't want to break now, pay the premium just for it to move 0.75% in the meantime. So I think you have to be looking at quite a substantial savings. So, for instance, if you were paying 1.5% more, but your rate was in 3 months' time, so you're paying a quarter of it, so call it 0.35 for these numbers, 0.35%, but you thought in 3 months' time the interest rate was going to be 1.5% or 1% or 1.5% higher, that would be worth it, right? So you pay that small 0.35% premium for a few months to lock in today's rates at 3.65 or 3.6 rather than pay 4.6 or 5.1. So to take it to the extreme, that's how it would work.
So as an example, maybe there's two examples we could talk about. The other day somebody was talking to us and we said, look, this is not really our thing, but they said, look, we can get 2.99 with a certain bank, but the rate runs out today. And they were already on 2.65, and it was not a huge break. It might have been, I don't know, like a month or something like that. And we said, well, that sounds pretty good. And it was some crazy thing. It was like 2.99 for 2 or 3 years. Now, we're no mortgage advisors, but we pay a mortgage, so I said, take it. That sounds pretty good. But, of course, double check with... I can't remember if they're using the mortgage lab anyway. But we always said, but double check with your mortgage advisor. Like, so some things are super obvious. That's sort of what you're saying. Like, if it's going to be super obvious, if it looks like a duck and sounds like a duck and walks like a duck, then breaking could be worth it. But in other things, you're trying to sort of really read the tea leaves, aren't you? And so where is it going to go? And of course, that has no factual basis whatsoever. So
no. So that's a great example. So let's have a look at that one. So let's say they owed $100,000 on their mortgage. Wouldn't that be nice? $100,000 on their mortgage. They're currently at 2.6%, so they pay $2,600 a year in interest.
Yep.
They can break. There's not going to be any break fees because we're in an increase in interest rates. So forget about break fees. But they could lock in at 2.99 now. Now, if they come back in 6 months' time, that 2-year rate is going to be mid fours. It's already low fours, so it's going to be low to mid fours. So they are saving themselves 1.5% essentially. Their view is that in 6 months' time, the 2-year rate is going to be 1.5% higher. They're paying 0.3% for half a year. That's great. They're going to pay essentially $150 more interest than they would have to lock in a below 3% rate now. I think, and so it's a no-brainer, right? Because we've taken that kind of to the extreme. So it's really good to nut out these ideas because you have to have a view of what the rate's going to be in the future and how much premium you're going to pay in the meantime.
Here's another sort of example then. What if we had a customer that had, I don't know, like $500,000, they're on, I don't know, a rate from last year, which might be 2.5%, 2.3%, maybe something like that. They're coming up for a break soon, I guess, and they'd be looking at a 1-year rate or a 2-year rate or a 3-year rate. So what sort of things, when they're talking with their mortgage advisor, what sort of things should the lender be asking, the person be asking rather?
Yeah, I mean, the decision between the 1 year and, say, the 3 or 5 year is fundamentally a cash flow versus risk thing. So you pay a lot more in interest, comparatively a lot more in interest to lock in for 5 years. So you're paying more on your mortgage. Money's going out the door a lot faster, unfortunately. However, for the next 5 years, you know what you are paying. Now, if we take it back a year, you could get 2.1% for 1 year, or 2.99% for 5 years. On the real specials, it sort of stuck around the 3.5, but you could get as low as 2.99%. I think so. You were paying a lot more, but I think no one's going to.
Sorry, it sounds like someone's ringing through to ask about their rates at this very moment. Yeah,
just going out live.
Yeah. Yes. Anyway, we'll get back to them later.
That caller wasn't ready to.
They weren't ready to lock in.
That's right. So I think anyone who locked in for 5 years last year probably isn't regretting anything, right? So yet they've paid that premium, but it could have easily stuck around the low twos for the next 4 years, and they would have been paying too high premium. So the thing is, if you want low risk but are willing to sacrifice some expense for that, you take the longer term. If you want short term, cheaper, but you've got a risk that in a year you're going to jump from 2.1 to 3.65, that is the risk you take. My preference, and this is not everybody's preference, my preference is you take short terms and you pay off your mortgage, because if you use that money, the extra money you would have paid on interest to pay off your mortgage, then your debt's gone. It doesn't matter what happens in 5 years, it's going off. That's my preference, but it's not for everyone. So that's why we have a discussion around it.
So in other words, if you've got the money available, then you might say, okay, had I taken this higher rate, which is a 3-year rate or a 5-year rate, I would be paying X. Could I instead pay that off my mortgage as extra payments? Because some banks, right, will let you pay off extra without penalty in each calendar year, right?
Yeah, it tends to be measured from when you fix the rate, is from that year to year. But yes, they'll allow you most will allow you to pay up to 5% of your mortgage off without any penalty. Now, a couple of them like you to do that in one lump sum, and a couple of them like you to do it by increasing payments so that you pay 5% of your mortgage off. But that's quite a substantial amount over a year. You're saving a lot of money.
So that's probably, perhaps, if you're thinking, how do I save money, but what's the market going to do? I don't know. I don't want to gamble with a future which is unknown. That perhaps is a practical compromise.
Yeah, I mean, the biggest way to win against interest rates is just not have a mortgage, right? Is to pay down your mortgage quickly, and of course talk to your accountant about which stuff to pay off first. Although it's probably less and less with tax deductibility, it's less and less important. But yeah,
we still think it's good to pay off your non-deductible debt first, and then leave your investment debt later, because at least you can still claim some of that, depending on your circumstances. But
who knows if those rules will change back, right?
Yeah, and who knows what will happen there. Okay, so that's good, really practical advice. What you've really stepped us through, Rupert, is, I guess, this approach, or a middle ground. And it sounds like it's not always numbers. It's about where how comfortable you feel with risk as well, and cash flow, as you mentioned. Yeah, and I like that suggestion, because I guess even like an extra $50 a week or something, if the budget allows for that, it's all going to help in driving down that mortgage, isn't it?
So let me use me as an example, for instance. So I would pay, I'm a mortgage broker, but I would pay a minimum amount on my mortgage on the cheapest rate, because my income fluctuates, because I'm self-employed. Now, at the end of the year, I will make a lump sum payment onto my mortgage once I'm comfortable. I know how much is retained in my business, but I kind of need that money in the business for fluctuations. So, but someone who was on a higher salary, who's on a good income, may choose just to pay either more, cheaper rate, more off the mortgage, or fix them for a longer term, and that would come down to their risk tolerance. But you can see how you cannot just talk to your neighbour and find out what they're doing and just do the same. It doesn't work because it's very much horses for courses.
Yeah. Okay. Yeah. Very good. I'll ring the neighbour back later.
Yeah. Tell him you're not doing it.
Yes, I'm not taking that advice. Okay. Well, that's really practical. Thank you. And I think in some ways I feel it actually takes a bit of the pressure off, because there's always somebody who's saying, "Oh, I got a great rate," but the implication is you didn't. What's wrong with you? But it's actually it is not so cut and dried, and even one could argue it's not. This is right and this is wrong. It's more value judgments, and each person's circumstances and mortgage and everything, they're all going to be different, aren't they?
Yeah, I think the only wrong decision is if someone says, "Why did you do that?" If you can't say because of this, then that it hasn't been thought through at the moment. So yeah.
Okay, very good. All right. Well, the second thing we said we wanted to chat about is borrowing to buy stuff that isn't a fixed asset. Like property, e.g. shares, crypto, NFTs. I guess we're interested to know what appetite do the banks have for that. But even just, I guess, initially observations these kind of investments there. Do you have sort of any general comments initially?
Yeah, I mean, look, as a caveat, I am not a bull on cryptocurrency. I've said it before, but I feel like crypto is a great idea and has its place, but it feels a little bit like the Motorola and Nokia of the cell phone industry, in that it's the first iteration of it, and there's a few bugs in the system, and it's not quite a touchscreen yet, and I'm waiting to see an iPhone come out, and an iPhone equivalent come out that shakes the cryptocurrency world. Now,
I'll just jump in and say, for those of you who don't know what Motorola or Nokia is, and you'll have to Google that. Yeah, anyone born after a certain year will be like, "What?" Yeah.
What is a Motorola?
Let's just throw out beta
the
versus
first
VHS.
version of cell phones, right? Yeah. So this is the big brick that you held to your ear, Motorola.
Back when the Earth's crust was still cooling.
That's right. Yes. Yeah.
Okay.
So the dinosaurs used to walk around with these big cell phones. Yeah.
Yeah. So, I mean, this is a good analogy because, obviously, Bitcoin had come out as in great, okay, it's going to be the currency of the future, but the transaction fees, etc., have kind of been what's killed it. So it's become more an investment to make on the gain. And then Ethereum, likewise, has got sort of high gas fees on it, and there's some minimum bars often to get even to just invest into that if you try and buy some on a crypto exchange. Whereas a lot of the newer, they're not really altcoins anymore, but a lot of the newer currencies then don't have those same limitations. They've worked around that, so they require a proof of stake rather than proof of work, so that's viewed as more environmentally friendly. So there's certainly validity in those comments.
Yeah, so full disclosure, I do own some Bitcoin, a laughably small amount, it would be fair to say, but I'm just sort of watching it and with interest. So the question is, how would the bank react if you turned up and said, "Look, I've got $100,000 of usable equity. I can borrow up to $100,000 on my house. I want to put it in Bitcoin or Ethereum or whatever." The answer will vary depending on the bank and how you pitch the story. But what I would say is that largely the banks aren't allowed to make judgment calls on your investment. What they can do is say, if that investment goes to zero, can you afford the mortgage? So, if you've got the kind of income that can sustain, you have to assume zero returns from your, let's just call it Bitcoin for easy, 0% return from Bitcoins, and it goes to $0. can you still afford your mortgage? $100,000, yes, you can. Then the odds are better that the bank will be happy about it. Now, a couple of things I would strongly suggest that you tell them the truth of why you are purchasing it. Don't tell them that you're doing renovations or buying a car. Just say, look, I'm wanting to invest, wanting to use this money to invest in higher risk assets. Here is my income, and I can afford a mortgage, over the amount of time that I've got left. So if you've got 25 years left on your mortgage, then you can. And realistically, even with the triple CFA, the banks should be able to give you that money.
Right.
The question is whether you would, and my basic formula for that would be that I am paying 3.5%. Well, let's say I'm paying 5% on my mortgage for the next couple of years. Would I expect more than a 5% return on that, whether you're staking it or whether it's a growth? I'm not going to say whether I think that is, but I'm sure anyone who's involved in cryptocurrency probably has a view on it. And that way, if you borrow $100,000, you pay $5,000 of interest, you're going to get whatever thousand out of it in returns. Is it worth it? Probably, yeah.
Okay, that's good. So it's not the bank. It's not that they're anti-crypto, but you do have to be upfront. It sounds like. Well, we think it's always better to work through your mortgage advisor, work through the mortgage lab, of course. Interestingly enough, that's a good point. Okay, you borrow $100,000. Let's say that you put it into a coin. Let's sort of pull up one here and see what they're looking like today. And you staked it to get a return. So if we look at something like Tezos, that's about 5.66% return. Cardano is about just under 5. Solana is just under 6. So you're kind of either just under or just over break-even point on those things, aren't you?
Because I'm sure everyone that invests in crypto pays their taxes on it.
Of course, yeah.
So after tax, you're getting about the same return as your mortgage interest rate. But look, that doesn't allow for capital growth as well and things like that.
Yeah.
So I imagine at this point, if anyone's ever tried to start a business, they're probably yelling at the screen at the moment, but the bank didn't like my investment in a business. And I do want to point out that the difference there is that by investing in cryptocurrency, you aren't cutting off your income source. So if I'm a salaried person and I want to buy a shop, then that income that I was borrowing is no longer guaranteed. It's now a shop, and that is the reason that the banks are a little grumpy about buying businesses leveraged against houses versus something that we're talking about where I still keep working day in and day out, and then cryptocurrency is an additional purchase. That's a little difference.
Okay, that's good to know. So I guess whether it's to invest in managed funds, like for example, chatting to Miles Flower from Money Planners, he said, in Australia it's quite a common thing, quite a part of your investment portfolio that you'll invest in property, you'll borrow funds to invest in managed funds, and I guess looking over the last sort of 10 years, typically we would say 8 to 12% is what the financial advisors tell us in terms of returns that you're looking at. So it kind of, the math stacked up. Okay, well maybe I'm paying 5, but I'm looking at probably around 8, so 3% or maybe a couple of $100,000, that's a good return. Whereas in New Zealand it hasn't been like borrow to buy shares, like seriously, so there's maybe a different world view.
Risk tolerance, I think.
Risk tolerance. So that was very interesting to find out that's the thing. It's a very common thing just across the ditch.
Yeah. So one thing to compare that to, which is almost exactly the same thing, but different. Fascinating intro, Rupert. Thank you for that. So if you are paying your Kiwisaver at 10%, say, you're a salaried person, you're paying your Kiwisaver at 10%, and you are paying your mortgage at the minimum rate, you're fundamentally doing that, right? You could have been paying down your mortgage, but instead you're leaving the borrowing there and putting it into managed funds. Now, you haven't actually physically applied for that money back and put it into the Kiwisaver, but you are channeling your money into the managed funds rather than paying any mortgage. And look, there's no right or wrong answer in this either. It's your view on future returns of the market versus future interest rates. But I think it potentially is more common then in that method in New Zealand than grabbing a chunk of money and putting it.
That's true. Right, so
funds.
You might not have gone and borrowed to do that, but instead of paying off the mortgage, you're using the funds for some managed funds, for some Kiwisaver. And Kiwisaver is managed funds by another name anyway. Okay, so good point. So it may well be that vast amounts of New Zealanders are in effect already doing this strategy, but they just hadn't thought of it. Yeah.
Well, I'd like to think so. I don't know how many people are overpaying their minimum payments on their Kiwisaver, but it would be nice if they were.
Yeah.
Look, when we're recording at the moment, the share market has not been kind to people, but over the long term, which is how you should always look at the share market, it's been a good return, right?
Okay. So, and I guess really then it's going to come back to whether you go into shares or crypto or NFTs or all the above, etc. It's going to be a bit of a discussion between, your risk advisor and your financial advisor, and your lawyer will have some thoughts, your mortgage advisor will talk to you about that, and then you make that decision once you've had that input.
Yep, and that's it, And I think as long as you are, I think where the bank will start to get nervous is if you had a freehold property, and let's say it's worth $1 million, and you wanted to borrow $800,000 to put it into Bitcoin or a new altcoin. I think that's where the bank's going to start coming, because that is clearly a large percentage of your net worth in a high risk product. When I say the banks don't have the right to judge, there is a line that anyone can see is far too risky for an average investor. But if it's a small amount, it's 5% of your net worth in a high risk thing, then I don't see the banks having a problem with it.
Yeah, and interestingly enough, just picking up on that 5% figure, I know chatting to Daniel Carney, another financial advisor, a couple of months ago, he'd said maybe 3% of your total investments should be crypto. So for many people, like if you've got $1 million house, that's 30 grand. It's not much out of the whole thing. So and so we sort of say to people, look, if you want to do that, just dip your toes in a little bit. And there's a few do's and don'ts so that you don't buy crypto and you send it off into some wallet that doesn't exist and then that's gone. So the way is, get a little bit of familiarity with that before you do a big pitch there for it. Okay.
Yeah.
All right, well, good to know. We really appreciate those insights, because these two questions have been something that have been on the to-do list for some time. So it's nice to get those insights and, again, just to demystify it for us.
The breaking the mortgage rate is a fascinating one, because it's not easily answered, and yet everyone's asking it.
Yeah.
So
final question: if this property investor or homeowner is looking at this video and going, "Well, those maths, you lost me at hello."
Me too.
Can they contact the mortgage lab and say, I don't know if I should break or not, I can't work the math out, and not feel like an idiot, but just a little bit of help there?
Yeah, look, absolutely. That's what we do all day, every day, really, and no cost. It's I think what you're not going to get from us is a crystal ball solid guess of the interest rates. We wouldn't like to put our money down with your money, fundamentally, on that, but we will talk you through the reasons why you might think it's going higher, or why the economists think it's flat or whatever, and then talk to you about the decision you'd make based on that sounding reasonable. So, and we'll do it a lot better than I've done it, so it'll be a lot calmer, and typically of a video we'll type it out, so you've got things to kind of see on the screen there. But look, that doesn't cost anything. That's we get paid by the banks to do that. So absolutely, give us a call.
Oh, that sounds great. Yeah, because I think that takes a bit of the stress out of trying to figure that out. And obviously, we can't expect advisors to make our decisions for us. We've still got to bear the responsibility for that. But at least if we can educate ourselves, then we're going to make a better decision as a result.
Yeah.
Lovely. Well, thank you so much as always, for sharing those insights with us today, Rupert. We really appreciate your time. And,
thanks for
and
having me.
as per usual, the Mortgage Lab contact details will be in the blurb below.
Brilliant, thanks.